Good afternoon, ladies and gentlemen, and welcome to the ZOTEFOAMS PLC interim results presentation for the 6 months to the 30th of June 2021. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to David Sterling, CEO, and Gary McGrath, CFO of ZOTEFOAMS PLC. Good afternoon, guys.
Good afternoon. Welcome to our presentation. I think Gary and I you can see we're here, you can see what we look like. I think we're going to go on, take the video off to maximize the bandwidth and audio experience and talk through the slides. So firstly, I would like to say that as we just think about our business, remind people that we run two basic technologies, autoclave technology and extrusion technology. And the autoclave technology is mostly what we'll be talking about today. That's 98% of our business. And we think about that in two different divisions: polyolefin, which is using commonly available polymers and creating high performance or higher performance materials from those, and what we call our high performance products division. And those are using more advanced polymers with attributes such as energy return for footwear or chemical resistance, fire resistance, etc. for aviation. So those two businesses use our autoclave technology, and essentially our capacity is interchangeable between the two. Our strategy is that we ultimately are looking at high levels of organic growth. We're not looking at acquisitions, etc. We are using our unique technology to create these enhanced materials, where we focus on particular markets where we believe we've got the highest advantage to our customers and therefore to us by our materials. And that's led us into areas like aviation, clean room insulation, etc. And the other part of our strategy is to use the assets effectively and efficiently. So therefore, high asset utilization levels, fill the assets with the polyolefin foams, and over time, with higher growth rates in our high performance foams, these have higher selling prices, higher margins. They use capacity more efficiently per unit of revenue, and over time mix enrich through higher growth levels of our HPP foams division. For the 6 months ended June 2021, we can see revenue up 39% to 48 million. If we compare that to last year, that 39% in constant currency, we would have grown a bit further to 50.7. And also importantly, given the odd comparative in 2020 with COVID, we're 14% of the comparative period in 2019. Our high performance products division has led the charge, with sales up 66% to a record almost 20 million in the period. Although the other divisions such as polyolefin foams up 24% and MuCell up 50% also performed very well. Actually, it's been quite a difficult operating environment. We've seen significant supply chain disruptions, Brexit disruptions, COVID, raw material availability and pricing challenges, as well as freight difficulties and pricing challenges. So all these things have given us gross margin pressures in the period, as well as planned commissioning of our Poland facility, which is come online in the first quarter this year and is our third major operating facility for foam manufacture. So Despite all these things, our growth in sales has overcome these gross margin pressures, giving us an adjusted operating profit up 47% to 4.8 million, and PBT up to 4.1 million. If we had, again, constant currency, profit would have been up 93% in the period. We've also improved our leverage ratio, which is important to consider how financially stable the business is. And with debt at similar levels to last year, our leverage has decreased due to the better operating performance of the business, and now is below 2 times. Importantly, for a lot of people, me included, interim dividend up 3.4% to 2.1 pence per share. By geography, you can see quite decent swings in our business, actually, but those are more marked by what's happening in the different markets or industries rather than geographies. So you can see rest of world, a very big increase. That's where our footwear products go, and a decent amount of our T-fit insulation. Europe, we've seen a strong recovery in general industrial markets. UK is actually lower than last year. 2 reasons for that. We had some government PPE contract last year, which started in June, and therefore creeps into the comparative number, and that's no longer there this year. It was a kind of one-off 6-month contract, but also UK not quite growing at the same rate, the underlying growth not quite at the same rate as the recovery seen in other markets. And the US heavily influenced by aviation business, which North America and Boeing in particular is our largest aviation customer base, and that's obviously an area where almost uniquely sales are down compared to the first half last year. It wasn't badly hit by COVID initially, the aviation business, and then really got hit very, very badly, and is not expected, for us at least, to start recovering till fourth quarter this year. If we move on to the financial review, I'll let Gary cover the details of that before giving a bit more colour on various business units and our strategy progress.
Thanks, David. So as David mentioned, revenue up to 48.2 million for the 6 months versus 34.6 the prior period, which was a 39% increase. And indeed, we had currency headwinds of 2.6 million, which would have taken us to 50.7, which would have been a 47% increase. And also, last year was a bit of an unusual year. If you look back to the year before, H1 revenue in 2019 was 42.3 million. So we're actually back up and above that period by 14%. Gross profit was 1.9 million, up 16% on the prior period. But the key really is the fact there's a lot of moving parts, and the gross profit margin was down to 28.9% from 34.8% in the previous period. And David touched upon that in one of the previous slides. The 4 main areas really start with the cost inflation in our polyolefin foam raw materials, LDPE primarily, and that really has moved to take the beginning of the year through to the end of June up basically 2x. And if you look at the average of the last 5 years, we're effectively now around 60% above that. We see that as timing. We expect that to reverse. We have taken some price rises in the period. They were implemented from the beginning of May, but we expect those costs to come down. Probably not this year, but we would imagine and anticipate them coming down to a more normalized average rate in 2022. In terms of significance, the next one would actually be weaker USD. HPP sales are almost entirely invoiced in dollars, and we don't have much of a hedge against it because we manufacture those products in the UK. So we have sterling costs, We have some raw materials in USD, but others in euro as well. So we're quite exposed. And as we've grown the HPP and grown footwear, that exposure has increased. And we took that in this period. In fact, total underlying PBT, as David mentioned, was 1.2 million impacted by FX. On top of that, we also have freight costs. Prices have gone up both into Europe in road, as well as out to Asia in terms of containers. And Brexit really hasn't helped either, with bit of COVID, bit of Brexit haven't helped with the efficiencies, and inefficiencies lead to increased costs. Be it, using an example, if there's some delays that slow us down a bit, we find ourselves having to air freight occasional products, which isn't cheap when you're air freighting foam. And then finally, we have started our third manufacturing facility, as David mentioned. Poland started up towards the end of February. Those costs hit the P&L together, operating costs plus depreciation, and their costs we didn't have in the previous period. And looking back 2 years, or 3 years, when we started investing in this plant, had we known COVID was coming, we probably wouldn't have taken the step right then. So the costs aren't being absorbed by extra capacity at the moment, but we anticipate that to start in the future. What does that mean for adjusted? Well, first of all, adjusted operating profit. Let me just remind you what adjusted means for us. It's not very much. It's £120,000 of amortization of acquired intangibles in 2021, and 150,000 in 2020. We add that back to the reported numbers. So those numbers: 4.8 million at the half year this year versus 3.2 last, up 47%. And that's actually a 9.9% margin, and an improvement against prior year, which demonstrates the operational gearing we get from additional sales. The actual costs in there: distribution administrative costs, distribution costs up a little bit, up to 3.6 million from 3.2, pretty much as you'd imagine, with higher levels of activity leading to higher levels of shipping, more costly shipping, and storage costs, and a little bit more marketing and sales spend. On the admin side, costs are actually in line with last year at 5.7 million. But if you actually strip away some FX credits, the net hedging benefits that we took through the period, admin costs are actually up about 600,000, but offset by the 600,000 to be back in line with what they were last year. Profit before tax 4.1 adjusted, up 47% on prior year. The tax charge is pretty much in line with the effective tax rate under the accounting standards. We use the estimate of the weighted average annual income tax for the year, so that's pretty much 21%, and it was pretty much around 19% last year. The result of that is an adjusted profit after tax of 3.3, up 44% on the prior year, which translates into a 6.71 pence earnings per share, up 42% on the 4.73 pence of 2020. And an interim dividend was approved by the board at 2.10 pence, as David mentioned, which is 3.4% above last year's period. If we now turn to the balance sheet, let me just start with the top right, the net debt reconciliation. Net debt is pretty stable. It's 35.6. It is the same number as the end of December last year, and just a little bit down on June 20. A couple of moving parts within there. This time last year, there was quite a bit of uncertainty around a whole bunch of stuff. So we made sure we drew down a little bit more cash than we needed just to be comfortable. That has worked its way back through this year. We're back to a level at 6.7, which is round about right. We feel comfortable holding. We have a facility that required us to repay 5 million at the end of June 2021 of our long-term loans. You can see a movement in the long-term loan. But we offset that by drawing down our RCF to maintain the same level of debt. That translates into a good covenant position. We primarily report on our leverage covenant. That's the one that really seems to matter for us, given that the other covenant, EBITDA to net finance charges, we're way above the minimum. But that leverage covenant came down to 1.86, below 2. and we were just slightly above that at the end of the year last year, and we were at 2.6 the previous year. And if you recall, last year, with all the COVID uncertainty around, we did actually increase that covenant to 4x for the 12 months to June 2020. So we were way below the 4, but we were also comfortably below the 3 last year, but in the right direction, and coming down. And let's look at the balance sheet, pull out a couple of key items. Tangible assets has been pretty key area of the balance sheet over the past 5 years as we've invested and increased our capacity. Not a lot of movement this year. That reflects the fact that additions are effectively cancelled out in the first half by depreciation. And the reason for the movement is more movements in FX in the period. Working capital has gone up. It's almost entirely related to business activity, and across all the areas. I'd probably pull out receivables as being an area that I'm particularly happy with. We've had 12 months with our overdues below 1%, and we actually ended June with overdues at 0.2%. So that demonstrates our effectiveness at collecting, but also the quality of our customers and arguably the importance of our products to our customers. Payable is very much related to raw material purchasing. That's the majority of our payables number, and therefore reflects, for the most part, business activity. Post-employment benefits you can see going down by 2.8 million. And that's almost entirely related due to in the period there was a significant increase in long-dated corporate bond yields. We connect with our actuaries twice a year, get an update at the half year. That's the number we've put into our balance sheet. As I said, net debt therefore pretty unmoved at 35.6 million. If I move on to just cash flow, just tie up any loose end here. Cash generated from operations, healthy, strong. We remain cash generative, 5.6 million, just below the previous period. And you can see the reflection of the end of the capacity of the committed capacity expansion programs, resulting in purchase of PPE below the prior year at 3 million versus 7 million the period before. And this time last year, we had suspended the final dividend for 2019. And this year, well, back in the interims last year, we reinstated dividends with the interim. And obviously we continue now, and we paid the dividend in the end of May of 2.1 million for the 2020 full year. And then finally, just a chart I thought worth bringing together just to sort of demonstrate the main headwinds that we've been seeing in the first half year, which I've referred to and David's referred to already, polymer and FX. And ordinarily, I present this chart. We have it in the back because we always get asked about how polymer prices developed, and it's normally a bit of a boring story to tell because there isn't much movement. But you can see there's been quite a significant movement in the last 12 months, from peak to trough, going from around 80 cents a kilo up to just touching 2. It's over 2x. The orange line is the average 5-year. So you can see we are facing some significant headwinds there at the moment, some of which we've offset with pricing, which David's mentioned. But we do believe this is temporary. We expect these numbers. We're starting. The visibility we have would suggest that supply and demand will start to balance again towards the end of the year, subject, of course, to any unexpected outages and so on. But we expect that to settle down. The price has certainly stayed stable for the last 2-3 months. And our expectation would be that will start coming down. The way this runs into our costing leads to a bit of a delay, so we don't expect any P&L benefit this year, but our anticipation would be that we would see that at the beginning of next. And then you look at the GBP USD rate. The dots really show the difference in average rate for the first half versus the equivalent period last year. That's about 8% impact, and as I mentioned, that's a 2.6 million revenue impact. 1.2 after which costs which go the other way plus the hedging. I don't show euros here. Euros actually naturally hedged with us. We invoice all of our euro customers in euros, but we purchase into Croydon all our raw materials in euro, so it acts as an effective hedge. On that, I'm finished. I'll pass you back to David.
Thanks, Gary. So just diving into various markets quickly. I see questions coming up. I think what we'll do is wait until those to the end to take those. I think. Thinking about markets, I think we have covered what's happening in some of the main geographical and segment markets, but what we are seeing is that an overwhelming kind of resurgence of general industrial demand, augmented a little bit by inventory build from very low levels at some customers. I don't think inventory is yet built to the level that is consistent with this level of industrial activity. I think there may be a bit more to go, but I don't think we'll see much of it in the second half. I think there's still nervousness around in some of the markets that would want to keep their powder dry a little bit and keep their cash in the bank. Footwear in particular has performed extremely well. We'll cover that in detail when we come to our HPP, but it's now 1/3 of group revenue. Aviation is, other than automotive, which has not really performed very well, aviation is the only market which is significantly down, other than PPE, which was in 2020 was a contract that kind of was about 10 million out of our 80 million sales and won't repeat. Aviation is the main sort of historically strong market that's down significantly, and it's falling from about in 2019 was well over 4 million sales in the first half, and is now about 1.2 million. So a very steep fall in that, which is normally a good high margin business and growing very well. And that is spread mainly in HPP and somewhat in our polyolefin market. As I said, our PPE demand is going to be negligible this year. First half of the year, it was 5% of sales, but the full year, it was well over 12% of sales. So very, very strong business there last year. And I think there were a lot of questions asked about what's going to happen to your business now that that's gone or disappearing. Are you going to be left with a big hole? Well, we're not. We're busy. The markets have recovered well, and I think that geographical growth that we've seen is really driven by the various markets that we're driving into globally. The other thing I want to talk about, just when we talk about this sort of high level markets, etc., is our resource technology. So, that is an important factor for our future growth. We're putting a decent amount of money in that and a decent amount of Capex on our balance sheet as well, planned for the year. So you can see a bit of a mixed swing. Polyolefin foams, getting to be a smaller part of our business, mostly because of the growth in HPP is outstripping polyolefin foams. I would remind you, 20-odd% increase in sales in the year. Moving on to polyolefin foams in a bit more detail. I think the biggest factor here, you can see the segment profit falling despite the sales going up. And that's as a result, as we said, mainly of raw material and also the Poland facility costs being fully loaded onto our polyolefin foams business, which currently is operating at very low utilization rates. And we expect that to increase over the coming years, but certainly better in the second half than it is in the first. We have put up price increases. We have put through price increases from 1st of May. Specifically, those are not designed to recover pricing from our customer based on peak raw material pricing. That's important because I know from many years' experience, when the customers perceive that you are pricing based on a raw material peak, they watch raw materials like a hawk and come back, and your sales guys spend a long time just talking about pricing and arguing with the customer rather than developing business. And the customer is an important decision maker in which foams to use. And if they feel that they're being taken advantage of, they will find ways to make life difficult for you or substitute your product out. So we've taken the view that we are putting prices up, but not at peak raw material. Customers are well aware of this, and we believe it will position us very well for the future, both with customer relations and actually, as importantly, keeping or enhancing our margin as prices stick over the long term. Now, this strategy does require that the raw material prices squeeze our margin is bearable in the short term, and it is, in our opinion. We're still looking, despite this, to come in at market expectations of profit, and it also requires that the raw material price does come back down to more close to the long-term average in a reasonable time. We've got good reasons to believe this. Again, I've been in the market for 25 years almost, and a lot of the signals that we're seeing in the near markets like Iran, Turkey, etc., prices are coming down quite rapidly, and that usually flows into Western Europe. We can see additional capacity coming on in Western Europe, and the margins that the polymer producers are making over their raw material input costs are at very, very high levels. So all of those things tell me that the polymer price rise will not be sustained. We could get a demand shock. I think that's unlikely on the increased demand. There could be supply chain disruption, which, with plant outages shortening the supply, that's possible. But I think we've already seen quite a lot of that. And typically when margins are high, the raw material producers are very, very quick to get the plants up and running. When margins are tight, they tend to be a bit more slow to manage their plants up from low levels of capacity. So we're in a situation now that I think the raw material prices have plateaued. We're seeing peak pricing. I expect it will be a plateau for a few months before coming off towards the back end of this year. And as Gary explained, we wouldn't see much impact in our P&L at this point. On the top line in margins, I think the only other thing is that the product mix in the second half is expected to be better than the first half, with a bit more aviation sales and the price increases coming through, and that would somewhat offset the raw materials inflation and cost escalation relating to supply chain, freight and Brexit difficulties. There's not much of a currency impact on polyolefin foams. We buy almost all our raw materials in euros, and by the time we figure out where we sell it and the price relative to selling price, etc., there's not much exposure there. So that's something that we expect to not impact in the full year either. Looking at our high performance products, I'll start with, we sell footwear, we sell T-fit, we sell aviation. Almost all are substantially dollar priced, or Chinese yuan, or which are dollar linked, really. So the exposure to the GBP dollar is much higher there. Even though we buy a lot of our raw materials in dollars, it's still quite an exposure. And that's something which knocked a significant amount. Our profit would have been, rather than 3.9 million profit for the segment, would have been 5.5. So it's really impacted our margin. We would have doubled our margin on 66% increase in sales there. The sales increase has come largely from footwear, very strong growth, 147%, and T-fit, which was up 30%, actually slightly behind our expectations, to be honest. We could have done a bit more in TFIT had the Indian market in particular not gone into lockdown and such a strict lockdown due to COVID. But still, nonetheless, a decent performance there. And as I said, aviation sales going backwards, down to just over £1 million in the HPP division for the year, which is a quarter of what we were doing 2 years ago. We do expect that to come back. We expect that. We already see the order book for the second half much stronger than the first half, and I don't think we'll quite get back to the levels of pre-COVID in the second half, but certainly good progress from where we are now. We do continue to invest in selling and distribution costs, and there's been a bit of a opening up of our wallet on that, mainly compared to the previous period where we had very tight cost controls in place to manage cash. So good progress on HPP. And in MuCell, the story is really mainly about resource, the technology from MuCell, where we license our IP to people looking to save polymer costs on consumer packaging. That's that business. Has been very difficult over the last 18 months because in order for our technology to be implemented, we need to be in the customer's facility with control of their machines, etc., and putting our equipment on. And firstly, nobody really wants our people in their facilities under COVID. Secondly, they've been conserving cash, so they've not been going forward with some of these projects. And thirdly, it's been very difficult for our engineers to travel. And so that business has been substantially impacted, the ability to operate. What we've done is we've pivoted a lot of our people and focus onto our recently developed technology called Resource. And I'll talk a bit about that in a couple of slides' time. But the important thing financially is that our MuCell 1.0 business, if you like, the existing contracts we have with customers continue to generate royalties. We do continue to have some equipment sales, and with some of our costs now positioned across the Resource, some of which get capitalized or required to be capitalized, you can see that MuCell moved into a sort of break-even position in the year, or in the period rather. Strategic progress. This broad-based recovery, I think, gives us very good momentum into the second half. Poland being commissioned under COVID, the guys have done a fantastic job there. It's been very difficult. It'd be difficult enough to commission a plant of our complexity in normal circumstances, but doing it where the very small management team on site had to do everything themselves and sort of fly by wire from the UK. The fact that it's up and running on time, has very good quality output. We've passed the quality audits, etc., of customers. Very, very positive. Although it's a short-term drag on the depreciation and overhead costs from Poland, it's definitely gives us a lot of opportunity for growth in the future. Footwear, a notable success. Not only we have strong order book, but good visibility. The one thing I would say in the second half is that a decent amount of our footwear business goes to Vietnam for processing. Vietnam is currently under lockdown, pretty strict, and that's going to take the shine off our footwear business in the second half. It's something we believe that would have perhaps given us more upside confidence in the numbers in the second half if that hadn't been the case, but it's just part of dealing with the current environment. So we can't ship to those footwear manufacturers, and they can't ship on to Nike. So yet to see whether demand through other manufacturers based in China will change. But at the moment, we're just anticipating a bit of stop-start situation in Vietnam, which will interrupt our supplies to footwear in the second half. Good growth from TFIT. Disruption mainly in India impacting us, and that's ongoing. China, a little bit of disruption with COVID causing rolling lockdowns in certain cities, but our teams have a good order pipeline and are pretty confident in the demand coming through at the second half of the year. And the resource technology progressing as planned. So it's been a busy 6 months. And if we look at what we've been investing in the past few years, capacity-wise, pretty much those large-scale restructuring, big capacity investments are already complete. Croydon, where we were investing to support our footwear business, which has obviously been very successful, and the US and Poland to support general business growth. The major investment's now complete, and in Boston or near Boston, Leominster, Massachusetts, we're putting our pilot line, which you can see in the bottom right here, to develop and showcase our MuCell resource technology. And that technology is something which I'm really excited about. It's a solution to today's problem, which is beverage cartons that you see in front of you. Familiar to most people, you'll see them on the shelves in supermarkets. You'll take them home. They'll either be in your cupboard if it's an aseptic, non-chilled product, or in the fridge. But basically, these are cartons used to transport juice, milk, that sort of thing. And in order to keep the products fresh, they require barrier properties. So that means oxygen and moisture can't transmit through the package into the product or out of the product. And so to do that, today there are about 300 billion cartons a year manufactured using paperboard, plastic, and sometimes aluminium. And because they're made from these multiple materials, they're very difficult to recycle. So if you put that in your recycling bin in the UK, there's about a 1 in 5 chance it'll actually get recycled, and 4 in 5 chance it'll end up in landfill or incinerated. And when they're talking about recycling, they're talking about stripping the fibre out and using it for something like toilet roll, and perhaps the plastic and aluminium to use in low-level building supplies. So it's not what the packaging brands, the retailers are looking for. They're looking for something which can be recycled back into packaging, supporting the circular economy. We have that solution using a 100% polymer solution, which can be recycled in the same way as a plastic milk carton. We can incorporate high levels of recycled content in it. And we've already approached a number of brands and retailers, high levels of interest. And at the moment, we have a sort of level of interest of over 1 billion cartons. And that's a fairly significant business. If we were to manufacture material for 1 billion cartons, it would be a business approaching, not quite, but approaching the size of ZOTEFOAMS today. And bearing in mind the market is 300 billion cartons a year, it's a very significant opportunity. We have a solution which is 100% recyclable, can use recycled materials, and has half the carbon footprint of the existing solution. And so the next steps for us are to fully validate this. That's why we've got a pilot line in Boston. And once it's been fully validated to our satisfaction, including turning things into cartons, putting juice in them, testing it sterile, etc., then the next step is to go to a full-scale production trial with a partner. And we are lining those up. We have partners in juice, in dairy and in alcohol. And also the technology can be used for pouches. So we have pouches are typically used for like squeezable foods or dry goods like granola or something. We have partners in that as well. Slightly different recycling challenge for those current packs. Again, generally not widely recycled where ours should be, and we've proven it can be. So very, very exciting development, but it's a kind of watch this space thing at the moment, because until we've completed our validation and then in-market trials, I think we can all get very excited about it, but there's a lot of work to do here. And then finally, just to kind of make sure everyone understands the position in sustainability, because ZOTEFOAMS, if you look at it one way, is a manufacturer of plastic foams, and plastics are bad, as everyone knows. Well, that's not quite the story, is it? Because where we see a consumer and societal pushback against plastic is inappropriate use, particularly of single-use disposable plastics, and particularly when those are done in a way that they are overused and not recyclable. So there's a real move to use the optimal materials. Most of our business today is making foams which are lighter, use less material, and therefore save weight on aircraft. They provide insulation for many kinds of industrial applications. They save weight in cars. They use less material. They protect goods in transit, etc. And all of these things, we can see the benefit of our materials being saving carbon compared to other solutions. And so we feel we're pretty well placed. And this has grown up over years because, quite frankly, if you look back 10 years ago, we didn't make a conscious effort to promote into long-term solutions, but we were just too expensive to go to the short-term ones. There were other solutions that were cheaper, and so we never got into those markets. And of course now it's a blessing, because we have demonstrable track record and performance in many markets where the foams are used as part of a solution, improving efficiency in the supply chain, etc. And that's a good place to be. And in common with many other manufacturers, we are looking at our own carbon footprint, not just how do we sell, but how do we manufacture. Product development to use recycled materials and our own scrap, improving operating efficiency. And I've seen some really interesting things we've done on gas efficiency, etc. We now buy in the UK and where it's available globally 100% green energy from renewable resources. And so these sorts of things we have been doing for a while, and we've adopted the SASB and the TCFD disclosure routes in our reporting framework, and we will be able to kind of clarify a lot of what we've been doing in the next annual report. So I just wanted to make sure people kind of understood that. And then just finally, key messages. Strong trading performance, dividend up, Poland plant commissioned. We're dealing in a tricky economic and supply chain environment, but managing it well. We do see further positive sales momentum. As I said, analysts are penciling in 99 million for sales in the full year, which gives us about a 6% growth first half to second half. We are obviously targeting, we want to get 100. It's our 100-year anniversary. I want to get 100 million sales, but let's see how we do on that. Gross margin will remain under pressure, but with the additional sales, we should see a better bottom line in the second half. And as we get normality returning, particularly in raw material prices, we should probably see a bit of a benefit going into 2022. We do, of course, consider that there are supply chain risks. Vietnam closing down very suddenly, obviously, illustrates that perfectly, and supply chain and operational disruptions remain. But we've proved adept at managing these environments and positioning our business well. So I think we take confidence from that the full year outlook is positive. So if I close off there, and maybe pick up some of the questions. Paul, do you want me just to pick them up, or do you?
Yeah, I was going to say thank you to both of you for the presentation. Let's hope we get to 100 on 100. Ladies and gentlemen, do please continue to submit your questions using that Q&A tab situated on the right-hand corner of the screen. But the team will just take a few moments to review those questions already submitted. And just to remind you that a recording of the presentation along with a copy of the slides and the published Q&A can be accessed via your Investor Meet Company dashboard. And also that just a quick reminder, your feedback is important to the company, and immediately after the end of the presentation you'll be redirected for that opportunity to provide your feedback. David, yes, and Gary as well, please, if you could just click on that Q&A tab, and where appropriate to do so, if you could read out the question and just give your response, that'd be fantastic.
Yeah, if I just take it from the top then. A question from Simon C. What trends are you seeing from your clients in the various markets you operate in as far as order flow and set of future orders? We've got pretty good visibility in the second half. The one area that we don't have visibility in is T-FIT insulation, and that's just the nature of the business. We provide quotes to insulate things like clean rooms and biotech facilities. And they sort of sit on them right to the end, and then they place the order and tell us to get the thing there yesterday. But we've got pretty good confidence. We understand what quotes are likely to come through. Other than that, I think we've got pretty good order coverage through most of the rest of the year, fairly widely across the business. We're not quite at the, we do expect further orders to come in, of course, between now and the end of December. But it feels like a pretty good position. Edward R., where do we see long-term gross margins and operating profit margins? Well, I think my initial reaction to that is in polyolefin foams, they're going to be an awful lot better. We've taken a significant headwind on the polymer cost, and if that polymer cost doesn't reverse back to long-term average levels, then our prices will go up, and I think competitive prices will go up. The margin will the market will rebase. So I do see that happening. Through margin expansion, through the polymer price going down. I think some of the inefficiencies that we've been bearing right across the business because of supply chain disruptions. Gary mentioned freight costs. Mentioned air freight and things like that. Those will reverse as well. Our HPP margin is currently 20%. We see, subject to currency, decent upside scope in that. T-FIT can be a very profitable part of that business. We're investing quite heavily in it at the moment, so that's depressing margins a little bit there. So mid-20s there, pushing up to 30s may be possible, depending on how much we invest in new products. And obviously, Resource MuCell at the moment is a drag on margins. We're not making any profits there, and we are investing money. So I think we do see considerable scope to upgrade the margins across the business. Next question. Has there been any improvement in freight costs? From George L. No, George, there hasn't really. And if not, how long do you expect this to continue? Certainly the rest of this year. I think it's probably going to be towards the back end of next year before the global trade supply balance reestablishes itself. I think the global trade patterns are very different than they were pre-pandemic, and the freight industry is particularly international shipping freight, is realigning. We may see freight costs to and from Europe coming down more quickly as more people get better at navigating the Brexit paperwork. But what we have seen is a limited supply of continental European drivers willing to come into the UK. They just can't be bothered with the paperwork. It's just too onerous and takes up too much time. So that's something that we're hoping people will get better at, and that will maybe get some more short-term relief on that particular freight cost. Edward R, what type of operational gearing should the business deliver, and what levels of plant utilization are you achieving? Well, it depends on product mix, Edward. I think if we look at some of our, very more high margin products like aviation, TFIT, the operational gearing there is much, much higher than, for example, the lower quartile polyolefin business. So, I think in the very, very short term, operational gearing, we should get 50% of the last pound of sales in any financial year is probably going to drop through 50% or more to the bottom line. But it depends how we think about the medium term and investment. We are very much an organic growth story. We see a lot of places for our technology to grow, and so we are investing in quite a lot in long-term development of the future. So we try and balance that. We're not trying to squeak across the line this year with a slightly better profit number at the expense of next year at all, or the year after even. So we do invest a decent amount of our expected operational drop through in reinvesting in the business. Ryan, HPP has grown very well. How much more revenue could you put through your current capacity before additional Capex is required? Again, that's a similar question or similar answer to Edward, which is about what products we look at. I think we did an exercise a few years ago which looked at TFIT, because the amount of sales per unit of capacity on TFIT is very, very high. And I think we calculated that if the whole business was turned over to making TFIT, we could make £250 million profit a year, which I've got to say is appealing to me and a few other people. But obviously TFIT isn't that big a market yet, and other things would happen if you start to make that amount of profit as competitors look over your shoulder, etc. But I think the point is that we have some very profitable businesses in our stable, and over time, what we want to do is mix and enrich, replace that lower quartile azote business with higher quartile HPP growth business, and over time that mix enriching will drop through in the margin. That's essentially the strategy. Next question, Edward, what's the annual maintenance Capex spend? It's about, if we include replacement IT, it's about 2/3 of depreciation, Gary, is that about right?
The specific maintenance, I mean, our total Capex is generally, the objective is effectively depreciation rates, which is about 9 million. Obviously, the last 5 years we've been as high as 20 million in 2019 because of the expansion Capex. So yeah, it depends what is specifically being asked there with maintenance Capex. But I'd say better is just to look at it. Our objective is to spend at levels that replace depreciation, subject to us identifying new opportunities that might require, like a resource that might ultimately require a bit more at a particular point in time.
Okay, Glenn, as retail markets settle, can you see a fall off in shoe sales in 2022? I'm not so sure it's about retail markets. The shoe industry goes through various cycles depending on when they launch products, etc. And I think we see broadly similar levels of sales for the footwear market in 2022 as this year. Maybe slightly lower due to kind of product cycles. If we end up having a disruption in Vietnam, maybe those sales will appear next year as they play catch up a bit. So no, we don't see any significant drop off at the moment. Christy, looking back at FY 16-18, operating margins were 14%. Given that HPP should have enhanced this, what are your medium-term aspirations? Well, there's a lot happened since 16-18. We've invested an awful lot in capacity for growth. Obviously, COVID's come along. The dollar's very different. So all of these things we need to kind of think about. But I think getting operating margins back to 14% is definitely possible. We're sort of 9 or 10% right now, but in constant currency, that would have been pretty close to that 14% if the dollar had been where it was last year. So I think that's that's definitely possible. Medium-term aspirations, as HPP grows, we continue to believe that HPP will grow more quickly than Azote, and as it becomes a higher percentage of our capacity utilization, the margins should stretch to closer to the HPP business unit margins, which, as I said, currently are at 20%, and in constant currency last year they would have been 26%. So there is a kind of view that pre-overhead costs, central costs, that those margins are definitely achievable. So somewhere in between the two, I think. And how quickly we get there depends quite a lot on how much we continue to reinvest. I could get the margins there an awful lot quicker if I didn't reinvest, but that's not our strategy. We are taking some fairly decent cost positions and looking at long-term opportunities. And I think when we talk about resource, for example, that's a good example of that. Glenn saying, if the carton business is successful, are you going to have to invest in new equipment? And how large an investment can you see being required? So here's the equipment required to make the carton technology is not the same as the block foams. So it's extrusion equipment. So if we go into, depends on our business model. If we're going to making sheet, then we would need to invest. That investment depends an awful lot on exactly how much we want to do in the supply chain. But we've figured out that the global market's about 300 billion cartons. One facility that we would put up with 4 extruders would potentially give us 700 or 800 million cartons a year, depending on whether we're 1 litre, 250 ml or whatever, but an average mix. So you can see that, that facility may be 30 million pounds, but that would give you a business which was, not far off the size of ZOTEFOAMS today. So it's a very big market. It's a very big question. The more successful we are, the more we would need to invest. I think, however, we haven't yet decided to invest. We haven't yet decided our business model. We've got a lot to prove there. And obviously, at higher levels of investment, we have to consider the risk appetite of the shareholders and the board, and also the the execution strategy, which may need, different partners in different parts of the supply chain. So I wouldn't get too worried that we're going to rush off and spend, tens of millions of pounds on equipment for resource at the moment. And if we do, we will have a jolly good story to back it up, and customers lined up for it. Okay, next question. Edward R. How long for validation studies of resource and to establish full-scale production plant? To do the first stage pilot validation and initial sterility tests, etc., we are estimating fourth quarter this year, and we're hopeful to get on commercial lines for full-scale pilots late first quarter next year. It may take a little bit of time after that for results to come through in terms of knowing we're successful. If we're unsuccessful, you'll know pretty quickly at that point, because it doesn't mean that you can't get there. It just means that particular trial wouldn't be successful. So that's the sort of time scale for validation on cartons. Next question: have your house brokers changed their full year forecasts? I don't believe so, Henry. No. They've kept the forecast the same. Do you see the space travel industry as a growth sector, Glenn? Yes, it is. We are on, as far as I'm aware, all major space programs. Our high performance ZOTEC F, which is a similar grade to use in aviation, is heavily used in interiors, seating, etc., because it passes the flammability and toxicity standards required, and it's nice and comfortable for interiors as well. So, is it going to be huge business? It could be decent. It depends how quickly they scale up to decent levels of activity. And at the moment, I believe that if every time a module goes up, they put a completely new interior in. They don't reuse the seats. I think if you're paying $250,000 per trip, I think you get to keep the seat. I'm not sure about that, but that's I believe what's happening. Next question from Gavin: how are you planning to build up Polish revenue? Well, the mere fact of having a facility in Poland allows us to access quite a fast-growing segment of the market in Central Europe. So not just Poland, Czech Republic, Hungary, Romania, certain parts of Germany, where it's quite difficult to service that market from the UK, has opened up. But ultimately, what we're going to see is some business transfer probably from the UK that we're currently doing in the UK over to Poland, as the UK facility, has higher levels of our HPP foams coming through. So our capacity gets more utilised for that, and Poland supports the polyolefin foams, which are much more of a geographical base. But I think rather than thinking of Poland as a standalone facility, it's more accurate to think of it as part of our global capacity footprint. And we could fill Poland tomorrow by transferring other business in there, and everyone knows that wouldn't help the overall profitability of the group. So I think what you see in Poland is that last tranche of capacity that is getting filled up group wide. And I would remind people that it only started up a few months ago under COVID. We haven't had any of our engineers there, our quality people, etc. So we want to build at a reasonable pace and make sure that we've got good quality and customer service out of that plant before we try and load it too heavily. Learn to walk before you can run, sort of thing. And as I said earlier, the guys done a fantastic job in getting where we are today, and I've got a great deal of confidence in them. So hopefully get over and see them soon, Poland having come off the red list a few days ago. I think that's all the questions.
Yeah. Thank you very much indeed. You've covered every single one off, David.
Yeah.
So thank you very much, and Gary as well. If there are any further questions that do come through, of course, the company will be able to review all questions submitted today. Just on that note, David, if I may just ask you just for a few final words as we turn back to that key message slide before we redirect the attendees to give you some feedback.
Yeah, so key messages, I think we have traded well. It is a difficult environment, so we need to keep our wits about us and not be too dogmatic about what we're doing. But we do see a recovery in the markets, and it's all about operational execution, making sure our supply chains are robust, making sure we overcome, when we see bumps in it, that we overcome those. So we have got further sales momentum coming through in the second half. We are watching our cost base very closely, and managing the supply chain challenges. But I think we've got a good portfolio. We've proved that the management team and the facilities can pivot between different business types and different markets depending on where the action is and where the problems are. And so we do feel very confident about the long-term future, and in the short term, we're doing what we said we'd do.
That's fantastic. David, Gary, thanks again for updating investors today. Could I please ask investors not to close this session, as you'll be automatically redirected for the opportunity to provide your feedback in order that the management can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of ZOTEFOAMS PLC, we'd very much like to thank you for attending today's presentation. That now concludes today's session. Thank you and good afternoon.